Hi guys. Today we will analyze Genuine Parts stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been a good performer in the overall market. The long and short-term trends are both positive. Strong support levels are around $142 and $136. Next strong support levels are around $120, $107 and $90. Strong resistance level is around $153. The stock is near all-time high levels. In the last month the stock has been trading between $134.50 and $153.90 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 0.8 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 4% per year, for last 5 years. We see that the average profit margin of the stock has been around 4% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 109% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Genuine Parts Company: bad, average, and good. First scenario. Genuine Parts will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 3%. Future profit margin would be low, 3%. Future free cash flow to net income rate would be low, 90%. In this case, the fair value of the stock today would be $54. Second scenario. Genuine Parts will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 4%. Future profit margin would be average, 4%. Future free cash flow to net income rate would be average, 95%. In this case, the fair value of the stock today would be $71. Third scenario. Genuine Parts will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 5%. Future profit margin would be high, 5%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $92. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 7.72. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Genuine Parts, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 19. Again, I will use 3 different scenarios for Genuine Parts Company: bad, average, and good. First scenario. Genuine Parts will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 3%. Future P/E would be low, 15. In this case, the fair value of the stock today would be $64. Second scenario. Genuine Parts will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future PE would be average, 17. In this case, the fair value of the stock today would be $79. Third scenario. Genuine Parts will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 5%. Future PE would be high, 19. In this case, the fair value of the stock today would be $97. As you can see, today the stock is overvalued, $152, even if we expect the company's high performance in future. While the company has a good profitability rating, there are some minor concerns on its financial health. Also, the stock is expected to show a small growth in revenue in the next 5 years, 5% yearly. Based on that, the stock looks overpriced at the moment. The company is a dividend king. I may consider buying the stock for the dividend, when the stock drops below $100. Company's strengths. Genuine Parts Company is an American service organization, engaged in the distribution of automotive replacement parts, industrial replacement parts, office products and electronic materials. It serves many customers from more than 2,600 operations around the world. The company's portfolio optimization strategy positions it well for higher margins and global business expansion. Its strong balance sheet provides resources to invest in these efforts, and to enhance earnings with small acquisitions. The company will benefit from growth in the number of vehicles on the road, as well as in the average age and complexity of these vehicles. The automotive and industrial part retail sector should consolidate around larger participants due to their superior levels of component availability. Genuine Parts should benefit from this trend for years to come. The company is a dividend king. It has raised its dividend for impressive 66 consecutive years. The stock currently has 2.35% dividend yield. Over the last 5 years, it has raised the dividend at a 6% annual rate. The company's return on assets of 7% and return on equity of 30% are amongst the best returns of the industry. Its profit margin of 5.4% is better than the industry average of 4.1%. The company also has a share buyback plan. Risks. The company faces risks from Amazon, which is stocking more auto parts, and from electric vehicles, which may not use as many aftermarket parts as internal combustion vehicles. Higher gas prices could crimp driving, and reduce the wear and tear that boosts the need for auto parts. Weather is another factor. Such companies don't benefit from mild weather as car parts are not being worn out. The same dynamic applies to the economy. In depressed economies, many consumers can afford to make repairs. The counter-cyclical nature of the auto parts industry suggests that when new auto sales are strong, sales at parts retailers will typically be weak, as the need for repairs declines. The company could also be hurt by currency fluctuations. In addition, the company may have difficulty passing on higher commodity costs to customers. The company has historically grown through mergers and acquisitions. It may have difficulty integrating acquired businesses, and may not be able to find attractive acquisition candidates in the future. The shares are trading near record high valuations. Over the long term, buying at high prices usually never works well. The company has a high debt level. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 5% on average per year. The earnings per share is expected to grow by 7% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.